Get what we need.
And this is this week's Closet Classic.
Hi, welcome to Burlington Magazine. I'm Tony Inverso. Our topic this evening is a topic that's of interest to a lot of people at this time of year, income taxes. And our guest is Steve Belmonte. Thank you for being with us this evening. When I get my tax forms, usually right after Christmas, the first thing that I look for is what's new in taxes. So maybe you could briefly tell us what's new for 1991.
The biggest thing that I think is on a lot of people's mind is the increase in the Social Security tax. The increase in the Social Security tax does not have a direct consequence on the return because it's not a return item. However, the tax itself has significantly increased over the prior year for the people who are in.
So people are having more withheld. Is this in general or just for people in a higher bracket?
Well, it's in general for everybody, but in the past or in 1990, the withholdings would stop at a certain level. I believe it was about 51.4 or somewhere near there. But for 1991, the limit went up to as high as 125,000. So people who earn $80,000, $90,000, $100,000 are still taking Social Security taxes out of their pay.
What else is new?
The phase out of exemptions for personal exemptions and itemized deductions for people, again, in those higher brackets. I guess Congress likes to go after those people with six-figure incomes this year. The phase out of exemptions starts depending on your filing status for single filers at $100,000, for heads of household at $125,000, and for married couples filing jointly $150,000. The phase out starts at those levels, and for every increment of $2,500 over that, there's a 2% phase out. The itemized deductions are also being targeted by Congress, and those deductions are being reduced at this point at 3% of adjusted gross income over $100,000. The thing I'd like to add to that particular comment is that it seems, in all the research that I've done on this, it seems to favor single filers, because a single filer is much less likely to have $100,000 than a married couple filing. Typical that they receive on their tax returns are W-2s and 1099s. 1099, there are...
Okay, what else is new, Steve?
Alternative minimum taxes have been increased in 1991 over 1990. Those now are at a rate of 24% versus 21%. Something that I think is going to have the movie industry up in arms a little bit is that cosmetic surgery is no longer deductible. Sorry, folks. And something that I think is going to affect most taxpayers in Massachusetts and throughout the country is the phase out of personal interest. They've been doing that over the past few years, but in 1991 is the first year that it's 100% non-deductible.
So that would include credit cards, student loans.
The interest on
those,
yes.
no longer deductible.
Yep.
Anything else?
Well, some of the good things would be the increases in personal exemptions and dependency exemptions for people in the not so high income brackets. Those were increased by $100 to $2,150. Increases in standard deductions for single individuals, married joints, for all filing classes. They go as high as $5,700 at this point. I think what they're trying to do is they're trying to index the standard deductions to coincide with the increases in inflation. They've increased significantly they've expanded the earned income credit program. Last year, 1990, the maximum
Could you
credit.
explain for a minute just what earned income is?
Earned income, well, that's money that you go out and you earn. It's wages, it's non-employee compensation. If you happen to have a independent contractor relationship with a company, it's money that you go out and
And what is the earned income credit?
first criteria is that you have to have worked, because by definition it has to be earned income. That the earned income that is on your return, or the adjusted gross income of your return, and when I say adjusted gross income, I'm referring to line 32 on the Form 1040, has to be less than $21,250. And you have to have a qualifying child live with you. A qualifying child would be one of your own children or a foster child.
Is there anything else that's new for?
Standard mileage allowance for travel expenses. If you happen to go on if you happen to be a salesman who spends a lot of time on the road, or you happen to be a person who just, by the nature of your job, spends a lot of time on the road, they've increased the standard mileage allowance from 26 cents per mile to 27.5 cents per sale of real estate, sale of stocks, at their fair market value versus the taxpayer's basis, which was previously the case. And not only that it was.
Can you give us an example of that, of how that would work?
That would be a situation where it would be a painting, an heirloom painting that someone in the family is no longer interested in, or stocks or bonds that may have been purchased years ago. For people who have no family and no one to leave these types of assets with, they can now donate them to charities and deduct them at fair market value.
Before a person sits down to do his taxes, what information needs to be gathered?
Whenever I sit down to do my return, the first thing I always do is I always take a look at the prior year's return. What I want to do is I want to reacquaint myself with my tax situation. I want to look at the earnings. I want to look at the interest. Did I close a bank account? Did I open up a new bank account? Or my dividends? Did I buy new stock? Did I sell stock? Every single component of your return is now bringing you back into the current year situation, and it'll remind you of certain things that maybe you've done. It's easy for a person like me to do that, because typically I think that people don't think of certain things that happen to them in terms of whether or not it's a taxable event, whereas I might, or I definitely do.
So looking at last year's return is a good memory jogger.
Absolutely, absolutely. Then it becomes a matter of gathering information that you would receive, and typical information might be this is what you would receive a W-2 in, and what's important to note is that people would receive important tax information, and not knowing that it was important tax information, they just throw it in the trash. So they enacted a law, and they require that the providers of this type of information put this.
So that's required by law. That's required by law.
I believe that it is important tax information. This is a typical 1099 statement. I believe this was a 1099 statement, and this is a 1099 dividend statement and a W-2.
So those are some forms that should
Those
be
are some of
gathered
the
before
forms.
you.
The W-2s, the 1099s for interest, for dividends, 1099B, which is a broker's statement for sale of securities proceeds that now has to be reconciled on your Schedule D, so that when you have a sale of stock, the IRS gets that information. So you're required to, by law, then report that transaction. 1099G, in case you happen to receive a state refund or you've received unemployment compensation. 1099R for retirement distributions. There's also a 1099 for real estate transactions as well.
Should these forms, and I'm thinking especially about the 1099s and the W-2s, be checked by the taxpayer for accuracy? Is that something that can creep up on them?
Absolutely, absolutely.
What could happen? Let's say I don't check my W-2 for accuracy and it's $100 off.
Well, if it's never detected, then it would just be, if it works to your favor, then you win. But if it works to your detriment, then unfortunately you lose. A lot of companies these days that I see are using automated payroll systems. And when you use an automated payroll system, there's a less likely chance of error. But we're all humans, and there's no guarantees.
Now, there's some receipts that should be gathered also before starting?
Well, going back to the question that we were just discussing about gathering your information and sorting information. Other types of things you may receive is a 1098, which is a report from your bank or mortgage company on interest paid, or K-1s. You may be a partner in a partnership, you may be a shareholder of a subchapter S corporation, or you may be a beneficiary in an estate or trust. All these types of things are now gathered in, and you start to sort through them. Other items that are pertinent on the return might be things that would be from an internal source. All the things that I've mentioned so far are things that come to you from the outside, so we call those external source documents. Internal source documents would be canceled checks, cash receipt tickets in case you happen to go out and make a $2 donation somewhere, or buy have a business lunch for $10 or $20 or something like that. Or any other pertinent information that would support the items on your tax return. Once you gather all this information, what I generally like to do is sort it out and put it in order to follow along with the return itself. Line 7 is wages, so then you start to work on it in terms of putting it in a worksheet form. So you have wages for line 7, the next one is interest income, and then dividend income, and you're summarizing all this information that you have, putting it in a logical form so that you can easily transfer the numbers onto the return. What's more important than that is that at some point down the road, if you're ever audited, you're not going through a maze of different piles. You have everything in a systematic, organized manner, which is important.
Steve, it seems that when a person sits down to do his tax return and gathers all this information, it can be pretty confusing. At what point should a person contact an accountant? Where does a person cross the line and say, okay, I've had it, I'm not going to do it myself, I'm going to contact an accountant?
Always call an accountant. I mean, come on. But basically, when I first got into the business, in personal relationship that I would have with non-clientele, I found that it was a lot more common among some of my friends and associates that they would do the returns. And in those days, returns were much simpler to do. An average person could spend maybe a couple hours, 3 hours, or some reasonable amount of time to prepare the return and save a tax preparation fee and feel relatively comfortable that it was prepared accurately. Then we call the CPA enrichment era, which is the Reagan years. I mean, this former president introduced major tax legislation almost every year he was in office, and people started coming to accountants and CPAs in droves to prepare their tax returns because it was A, too complicated, and B, much too time-consuming. I mean, so they pay a fee, but they are ensured that it's accurate. Generally, today, with the changes that are still being made, unless you've got a basic return, and when I say a basic return, a 1040 EZ or a pretty straightforward return that's just got some wages, some interest, I would, even in those situations, I would strongly advise that if you have a personal friend or family member or a professional associate who does returns for a living, to at least have them look it over. But I think in most cases today, people really need to seek professional help.
Because of the changes in the tax laws during the 80s and because of the fact that the forms have become more complicated.
Exactly.
These tax preparation fees, they're deductible, aren't they?
Tax preparation fees are definitely deductible. However, what happens is they fall into a category called miscellaneous deductions. And with the Tax Reform Act in 1986, I believe, Congress enacted a 2% limitation on miscellaneous deductions that normally go on Schedule A on the Form 1040. So basically what that means is if you have adjusted gross income of $40,000, the first $800 worth of miscellaneous deductions gets kicked out. So if you pay an accountant or a CPA $150, $200 to prepare a return and you have no other miscellaneous deductions, then in essence it's not deductible. But when you add other miscellaneous expenses like union dues, professional dues, professional subscriptions, subscription to a Wall Street Journal for people in are generally deductible. Other miscellaneous expenses might be job-related educational expenses. You may take a class to enhance your personal computing skills or personal other skills. Office and home expenses, investment expenses, and unreimbursed employee business expenses, which are normally reported on Form 2106, sometimes will flow through and hit that criteria of miscellaneous deduction.
What kinds of expenses go on a 2106 form?
Well, by definition, the 2106 form is called employee business expenses. These types of expenses are captured on a Form 2106. Travel expenses, meals and entertainment expenses. You may be a person who is a manager of a company and want to establish closer ties with certain customers, and you take them out and you entertain them. Things like that are normal and customary business expenses, and if the company doesn't reimburse you for, you're certainly entitled to a deduction.
What happens if a company makes a partial reimbursement?
Then you're entitled to deduct the difference between the total expense less the company's contribution. Depending on how it's reported, I've seen it handled different ways. It can normally, the amount of the reimbursement goes right on line 7 for included in wages. As a general rule of thumb, record keeping is absolutely imperative in this area. If you're claiming travel expenses, you should absolutely have a log. If you're wining and dining people and you're taking them out to lunch or dinner, as a general rule of thumb, I always ask who, what, where, why, when, and how. And if you can answer all those questions in a logical form to support your deduction, then I think you should do okay in an audit.
Steve, when should a person be making estimated tax payments? Is it something that just comes along with a little bit of guilt? You feel like I'm going to send a little money to the IRS, or is there a point at which estimated tax payments really need to be made?
Well, they'll always welcome money to come in, absolutely. But generally, for estimated tax payments, people who find that they have taxable income and not enough or zero withholdings to go in against that taxable income really need to be making estimated payments. These are the types of people that might be self-employed, people who may be unemployed and receiving unemployment benefits.
Which are fully taxable.
Which are fully taxable, both on the federal level and on the state level. Estimated payments are due on a quarterly basis in April, June, September, and in January, all on the 15th. I believe they give you the 1 month grace period in April because of taxes, the tax filing. But the law reads that 90% of your liability must be paid in order to, excuse me, the law requires that 90% of your tax liability be paid in through withholdings or estimated payments, or people could be subject to penalties and interest.
Now,
There are certain exceptions to that, but
is that to be paid in prior to the end of the tax year or prior to the filing of the return?
well, they want it paid in on a quarterly basis. There are different methods of doing that. You can take it on an annualized basis, annualizing your income, or you can do it on an actual basis, taking each quarter's income and paying the estimated taxes on that quarter's income.
One last question that is somewhat tax related. I think one major area of confusion when people are not running to their accountants to ask for help is when they start a new job and they have a W-4 form put in front of them, or even if they're not starting a new job, if they just want to revise that W-4 form and they're not sure of the number of exemptions to take, what would you advise them to do?
I would advise them to take a very close look at that because you may recall President Bush was on the TV recently addressing the country in a State of the Union. And one of the things he spoke about in that speech was that he wanted to lower the withholding tables for American taxpayers. And in essence, what that means is he wants to put more money in the pockets of American people. Well, that's all fine and dandy, but now the surprise is going to come in April of 1993 when people are filing their 92 returns. They may be finding out that they will definitely be getting less refunds. The people who are borderline might now be paying instead of receiving small refunds, or the people who normally pay are going to be paying more. Therefore, when you take a look at the exemptions, you really have to take a close look at that because there are numerous criteria that goes into this particular form. But as a general rule, income, then you have to look at each item and then annualize the amount of withholdings that occur on a weekly basis to see that it meets at a minimum that 90% requirement. One of the things that they allow you to do, depending on your personal tax situation, is if you're single and you claim zero and it's still not enough, you may have some other income. You may have some significant interest income or some other income. The IRS allows you, and it's right on the Form W-4, after you claim your exemption amount, the next line is additional amount withheld that you want withheld, if any. So you could put in zero plus another $5 per week or $10 per week. And that's
the advantage of that is your taxes would be paid at the end of the year instead of
exactly
getting a bill in April. Or
because one of the things you definitely want to do is you want to avoid becoming known to them, I guess is a general rule of thumb, because I've heard more horror stories about people who, on a simple matter, they get into the computer system and then it's just that spitting out all kinds of notices and
so they get flagged for one thing and then they keep getting flagged just because they got flagged once. Steve, in your years of experience as an accountant, what's the most common mistake you've seen people make with regard to their tax return?
Don't wait until April to call your accountant. Do the returns now. Sit yourself down. Go through the hassle now, because then when April comes, it's no big deal. If you have to pay, then you'll pay. If you get a refund, you'll get the refund sooner. So get it done.
Don't wait. Get the information together, and
Absolutely.
If you're going to call an accountant, call them now. Well, Steve, I'd like to thank you for being with us this evening.
My pleasure, Tony.
For Burlington Magazine, this is Tony Inverso.
Hi, I'm Tony Inverso. Burlington Magazine is a program that's dedicated to bringing practical information to Burlington residents. If you have information that you would like to share with the community, or you have a particular topic that you would like to see us pursue on Burlington Magazine, please drop us a line. The address is BCAT, care of Burlington Magazine, Post Office Box 740, Burlington, Mass. We look forward to hearing your comments and suggestions. Again, the address is BCAT, care of Burlington Magazine, Post Office Box 740, Burlington, Mass.